friends with the National Real Estate Post and Mortgage Shots. I have Scott Grubel, who's an account executive over at Angel Oak doing non-QM loans specifically. And boy, that's a big one right now. When you work with a company, you want to work with somebody who's doing only non-QM loans because, frankly, they have an opportunity to go ahead and make exceptions and really understand files. So anyway, Scott, how are we doing today?
I'm doing great, Brian. Thanks for having me.
Okay, so let's just jump into this. You have 70 some odd files going on right now. Mm-hmm. How did you get there?
It's been 9 years of hard work, blood, sweat, tears, sacrifice, but most importantly, 9 years of building relationships. That's really how my business has grown to where it is. Obviously, a lot of discipline, a lot of organization, systems and processes that have allowed me to scale my business. I really relate it mostly to the relationships I've been able to build over those 9 years.
I mean, let's split hairs on this, though, because everybody goes out there with that intention. But what are you doing different that allows you to pick up market share when other people don't?
I'd attribute it to a lot of what I'm doing today is marketing via social media. I do a lot of marketing through Instagram, Facebook, LinkedIn primarily right now. I'd like to expand into some others. That marketing has allowed me to really outreach and touch more people. I can put out a video about a product, a program, or an enhancement that we're doing, or a special that we're running, and instantly touch basically my entire database of contacts and accounts that are approved with me with just putting out one quick video. It's a lot more efficient, and I can multiply those touches by putting out multiple videos throughout the course of the week or a month. So that's been huge in really growing and expanding my business and making sure I'm in front of all of my customers constantly.
I call that leverage ratios. I mean, if I could talk with one person or talk with 10 people or talk with 1,000 people, social media really gives us that opportunity. But somewhere in that whole equation, I call that 30,000 foot bombing. And then you have to send in the infantry troops. How many phone calls do you make a day?
Yeah, I've had a few days recently, over 100 and change on phone calls. I'll look back sometimes to kind of just look at the phone history and scroll through, whether it's outbound and inbound. I'm not doing as many outbound calls in terms of outbound soliciting new clients. Thankfully, like I said, over 9 years, my business has grown to the point where a lot of it is organic growth. But I do get a lot of inbound phone calls from prospects and new clients or new loan originators or accounts that I haven't worked with before, simply through all of that social media marketing. They see a video, they see a post, and they'll reach out directly to me on it.
But you had to get there to start with. Like, we just don't wake up with this really flourishing social media presence. One of the realtors I work with, she said, when a rocket takes off, 80% is like leaving the atmosphere. 20% is when they're flying around. Mm-hmm. So what's the heavy lifting you did in order to get to the spot you're at right now to where you can actually accomplish the things you want to? What you just said is you said you take inbound phone calls, but we don't start there. How does that happen?
Right. Oh, absolutely. When I first started out, I was out in the field almost every single day. I'd spend 4 days a week out in the field soliciting, going and visiting new accounts. Every account within my zip codes of my territory here in South Florida, I would go out and visit, collect business cards back then, put them into our database, follow up with an email, follow up with a phone call. And personally, I had a touch system. I personally wanted to make sure that I touched every single one of those accounts at least 5 times. By the 5th time, I was no longer a stranger. I was, Scott from Angel Oak. And it was just a matter of building a relationship, building trust, getting them to know who I am, which company I work with, and then started to be able to get some of that inbound phone calls, scenarios, which turned into loans. And then from there, it's just a matter of building that trust and earning that relationship.
But it's interesting because you said you have a metric. Like, your metric is, I have to talk with these guys 5 times.
Absolutely.
So you knew that going into this, I have to hit this person 5 times no matter what.
I knew that it required that many touches to break through the wall, so to speak, to where I was no longer just a stranger, right? Back then it was a little bit different. We're in a post-COVID era now, but back then, you still had a lot of AEs out on the streets visiting accounts. You could walk into an account, there might be 4 AEs there from different companies. It's a little bit different now. We're obviously making contact in different ways. But yeah, my goal was to get past that 3rd or 4th touch, so where they instantly were able to look at my face and say, okay, that's Scott. He's with Angel Oak. He specifically does non-QM. He's the bank statement guy, the DSCR guy, etc. Because I knew once I got to that point, then we could start to really develop our relationship.
Okay, so you talk to somebody 5 times, but like every conversation is not the same. How do you find a way to stand out amongst, as you say, you're dealing with other AEs, and that's true. So how do you find a way to stand out?
Well, obviously in certain cases, you might have a unique product, right? Or you might have something that you do as a lender a little bit differently than some of your competitors. But for me, it was always standing out with service. I always led with service. I always led with my commitment. When an originator chooses to send a loan to me, and to this day, I still look at it this way, they're trusting me with their paycheck. They're trusting me with their referral partner. They're trusting me, obviously, with their borrower. They're trusting me with their livelihood. I don't take that lightly. I think that's very important to remember that as an AE. Every single time you're working on a loan for a loan originator, they are entrusting you with all of that. And so I always led with that. For me, that was number one, is building that trust, letting them know, look, I'm going to take care of your borrower as if it was my own. I'm going to look out for your loan as if it was my own, as if it's the only one I have on my desk, because I understand the importance of that loan to you.
You said something earlier. It's not our first conversation. And you said with every one of your files, for which you have many right now, you're looking at all those files and you're kind of quasi-underwriting them.
100%.
And that really kind of tells me how important your files are to you. Talk about that for a minute.
That's a separator for us at Angel Oak, in my opinion, respectfully. A lot of the industry and non-QM space has kind of started to go away from pre-approvals or pre-qualifications. We have kind of leaned into it even more. And at basically every single loan that comes in to Angel Oak is pre-reviewed and pre-approved by an account executive. So the 1003, the credit report, is being uploaded through our website securely, along with the bank statements if it's a bank statement loan. We are looking at all of that information. I'm looking at the credit report, looking at the trade lines, looking at the credit depth to make sure it meets guidelines. I'm looking at the 1003 in detail, to your housing history, employment history, assets, liabilities, etc. REO, obviously, to make sure it meets guidelines. We're running the income calculation on a bank statement loan, going through the bank statement income, reviewing it with the loan originator, and we're addressing any potential issues on that loan up front. We're going to structure that loan, put it together, and then I'm going to send out my pre-approval. Our pre-approval is our version of a DU approved eligible, right? It's going to give you your terms, it's going to give you your findings, it's going to give you your pricing. And when you receive that approved eligible, when you submit that loan to underwriting, 99.9% chance you're going to get an underwriting approval, unless there's something that was out of my control, your control, or that we weren't aware of that just pops up out of nowhere. And I think for that reason is why we have such strong conversion ratios. I was converting at about an 80% rate last month from submission to closing. Company-wide, we were over 70%, maybe even closer to 75% from submission to closing. I attribute that directly to the fact that we are reviewing every single one of those loans up front in detail with our originators before they ever get submitted.
It's kind of funny. I was having a conversation with Jeff out here in California, and we had a conversation on a deal, and he goes, no, that's not going to work. But you know what? That's really kind of powerful, isn't it? Because now we don't have to kind of deal with the ancillary, is this going to work or not work? It was very clear up front, but that's like the level of confidence he had with his products. And frankly, in this industry, knowing a no like on day one is better than knowing a no on day 29.
100%.
So let me ask you this. I mean, totally in the weeds on this one, because I believe in this. It's how you conduct your day before you start your day. What do you do?
I'm a creature of habit. If I get into real detail, a little more detail when we're into early, I wake up every day. I actually hit a cold plunge first thing in the morning. Wake me up, get the juices flowing. I jump into the gym. I get a good workout in every morning. And then after my workout, I can shower and sit down and be at my desk somewhere around 9 a.m. ready to go. Juice is flowing, mind's going, everything's going, and I'm ready to fire away. That's basically my morning routine every day. I'm a creature of habit, and it puts me in a position for success throughout the day.
So let's talk about your products right now. Like, what makes Angel Oak stand out? So I know you have a couple of things that you're doing that, frankly, nobody else in the industry is doing. Yeah. What are we doing?
Two of the products that stand out for us right now are, first, the home equity lines of credit. I like to call them our non-QM home equity lines of credit, because they were geared more towards the non-QM borrower, the bank statement borrower, or the borrower who maybe purchased an investment property using DSCR. So the home equity line of credit, for all of those bank statement borrowers that purchased a home over the last, 4 years or so, they obviously are sitting on a generational rate on that first mortgage using bank statement program. They're not going to refinance that first mortgage, but they may want to tap into that equity to consolidate debt or whatever the case may be. The home equity line of credit program, where we're qualifying them using the bank statements the same way they qualified for on the first mortgage, is a huge product for us right now. Loan officers that are using it to their advantage and leveraging it and basically just, making their borrowers and their database aware that it's out there are starting to really see a lot of volume on them. So that's one niche for us. On HELOCs, one thing that we do differently here is we actually use an AVM where we can run it up front at the pre-approval stage to determine the value on the property and get to our CLTV. And we do that right up front. So if we run the AVM at the pre-approval stage, we basically need two things. The loan amount has to be 400 grand or less and a CLTV of 80% or less. You meet those two criteria, we can run the AVM. And now we know exactly what the value is for that property at the pre-approval stage. More importantly, no appraisal is required. So that increases the speed in which that file moves through the system.
I mean, that's a really big issue if you think about it, because you're getting that out of the way on day one, not day 31. So because if you get like an appraisal on this on day 31, if you don't get your value, and by the way, right now we're in declining markets,
yes,
that becomes problematic. So this is actually a huge deal. I don't want to gloss over this. This is really important. So the fact that you're doing this on day one is giving your loan officers an opportunity to really close more deals. And that's why you have an 80% close ratio.
It enhances the surety of execution because we know exactly what that appraised value is up front, what our CLTV is up front, and eliminates a lot of the question marks from the equation.
Are you seeing this a lot? Because I just read a study a couple of days ago that said that 40% of all homes are owned free and clear. I mean, we are going to see a massive diaspora between people who owned houses who, frankly, are passing away. My parents' generation, nothing personal. But we're seeing, trillions of dollars that are going to change hands in the coming years. Are you seeing some of these HELOCs as first mortgages?
We are. We're seeing a lot of them, more than I expected, frankly. We do HELOCs, first mortgage HELOCs, first lien HELOCs on the bank statement side and on the full doc side. And there's a lot because, when we first rolled that out, I was like, okay, all right, we're doing these. I didn't realize until I started getting the phone calls just how many properties out there are free and clear. And people are using these products to be able to tap into that equity. Absolutely. That's a big one.
Dude, it's like 1 in 2.
Yeah.
It's like literally almost half the properties, 40% right now. So when you're borrowing secured money against a house, you're going to get a rate that's going to be half of what you would get outside of it. And we have $1.4 trillion in debt right now, and your average interest rate is going to be somewhere around like 19%. And we're seeing as high as 28%. So if you could borrow at 10%, which could be a cash write-off for half of you, boy, this is a really great opportunity for people to go ahead and like take money when they want, put it back, and kind of use their house, that secured money, is an opportunity for them to really kind of get ahead.
Yeah, a lot of cases on those first lien HELOCs, the rates are even lower than that because our rates on the HELOCs are based on the Wall Street Journal prime rate plus an index. That index is going to be, plus a margin. And that margin is going to be determined based on the CLTV, the credit score, et cetera. So on the first lien HELOCs, we're seeing very low CLTVs. And when you do the math on the Wall Street Journal prime rate plus that, it's could be in the 8s, 9s. It's a very competitive rate.
So highs and lows on your margins, where are we at right now?
I don't have a number I can give you exactly, Brian. Again, it's really going to depend on the credit score. If you're at a 90% CLTV, the margin's going to be higher. If you're at a 40% CLTV, it'll be a lot lower. And we go down as low as 660 credit score. So the credit score will determine it a lot.
I mean, can you see this like as a marketing opportunity for loan officers? You just go out there and find the people who are free and clear, which, by the way, is easy to do. And if you were to get something that's like sitting at a 50 or 60 LTV and you're borrowing money against your house rather than those credit cards, do you know the difference that would be to people? It's huge.
It's a no-brainer.
This is massive.
It's a no-brainer. And literally, as an LO, all you need to do is contact your database. Go back to your database, look at anybody you've closed a loan for in the last 3 or 4 years, whether it's bank statements or not, because there's other full doc or more conventional style HELOC products out there, and just reach out to them. I mean, it's business that's just sitting there. I can pretty much guarantee you the overwhelming majority of your book of clients in one way or another is looking to either consolidate debt or tap into the equity because they could probably use those funds.
I mean, it's kind of logical. If I'm going to borrow $50,000, I mean, do I want to do it at 10 or 19%? Kind of a no-brainer. And when you deal with logic, I mean, this is kind of like a turkey shoot. It becomes kind of an easy thing to do. Don't you think so?
Absolutely. Home run.
All right. So let's talk about DSCR. Now, here's the whole thing, guys. DSCR, they are not all made the same. You're getting phone calls from your AEs that I'm getting right now, and everyone says, well, we have a DSCR, it's really good, but Angel Oak has something that's fundamentally different. So let's talk about that.
That's correct. It's unique to Angel Oak. Just like the AVM process that we run on a home equity line of credit up front to determine the value, we are currently using AVMs to determine what the average market rents are going to be on a DSCR loan. So this is huge. This is a game changer because it takes out all of the uncertainty. We know, Brian, the biggest issue we have on a DSCR loan is, the reality is it's a little bit of a crapshoot. We can pre-approve it up front. We can look up market rents as best as we can on whatever tools are available to us. But until that appraisal comes back with that 1007 rent schedule, the reality is that we just don't know what that DSCR ratio is going to be. And we've all been in that situation where we've priced the loan, maybe locked it, had that conversation with the borrower, disclose it at a particular rate, assuming the DSCR ratio would be at 100. And then that 1007 comes in and we find out we're at an 80, right? And that will completely change the terms of the loan. It might affect your LTV, it might affect your rate. We are removing all of that uncertainty from the equation by running this AVM up front at that pre-approval stage that I mentioned earlier that we do on every file. So we will know right up front exactly what the rent comp amount is that we can use.
You'll use that AVM.
That's what we're using all the way through to closing.
That's big.
We will no longer require a 1007 when we've run the AVM and we're using that for our rent comp.
You know, I mean, the alternative is that you find somebody who wants to, get an investment property. And then what happens is you go through the process, you spend $100 on your credit report, you take these people down this road, only to find out that your rent survey is going to come back, your 1007 is going to come back, and all of a sudden you don't meet your DSCR ratio. Now, when you do that, by the way, it's going to cost you over $1,000, or at least it is for me. Like, that's what I spend. So when you get that appraisal and you get that 1007, you're looking at a lot of money. And how do you feel when you tell that client, oh my God, this isn't going to work because we just failed one of our guidelines? The cool thing with Angel Oak is they get this stuff done up front, and they are the only company in the country who's doing this right now. Can you imagine how powerful that is? My thing is, I tell all these realtors, go find the properties that you think would be a good investment property. Let's put together a pitch deck, and then let's go have that conversation with an investor. And so we kind of turn the whole thing ass over tea kettle to where we're finding the property first, and then we find the client afterwards. And it's a much easier closing. So you guys really facilitate this whole thing. What percentage of your business right now are these DSCR loans?
It's any LTV at 75% or below. So
that's crazy.
It's the overwhelming majority. We do get a good amount that come in at 80 or 80. We go up to 85 LTV on a DSCR program, which is unique. So at 80 and 85, we do still need the 1007 rent schedule. But if you're at 75 and below, which is a huge portion of our DSCR loans, we're using the AVM to qualify.
So right now, you'll go 85 on your DSCR?
We'll go up to an 85 LTV. So our DSCR program is extremely flexible, Brian. At 80% LTV and above, up to 85 LTV, we do need the DSCR ratio to come in at 100. And as I mentioned, we have to order a 1007. But at a 75% LTV, we will actually allow the DSCR ratio to go down to a 0.80. So that rent can come in, whether it's
crazy
or 1007, it can come in at 20% less than the proposed PITIA. But in addition to that, we also offer the option to use interest only, and we will use your interest only payment to calculate the DSCR ratio. And we do that up to 80% LTV. We also use short-term rental comp. So if the property is going to be a short-term rental, we can pull an AIR DNA report up front, gives us the average annual revenue for that property on the short-term rental market, and we use 100% of that rental income. We're not giving it a haircut. We're using 100% of it. We don't require any of the overall scores that you're showing on AIR DNA. So it makes it a lot easier. And then furthermore, if we drop the LTV to 70% or below, we actually offer a no DSCR or a DSCR waiver option. So if borrower's putting 30% down, really doesn't matter what that rent comp comes in at. The DSCR ratio can be 20 and the loan will qualify.
Well, hang tight. At 70, you don't even have to get a ratio?
70% on a purchase, 65% on a refi, no ratio required.
Listen, guys, I'm telling you right now, if you go to your past client database, which I call my best opportunity, and you say, would you like to double your real estate holdings right now? I mean, think about buying in California or maybe even like some areas in Florida where you're at right now. And you could pull enough money out of your house to go buy a house or two houses somewhere in the Midwest. And the hottest markets in the country right now are Buffalo, New York, and Indianapolis, Indiana. If you look at some of these kind of Rust Belt states, you can get 2 or 3 properties. My old boss did this. And at 30% down, you could go ahead and buy anything that you wanted to buy and double or triple your real estate holdings. This is massively, massively huge. And everybody would do this if we just reached out. So let me ask you one final question. You got that Golden Dome behind you. I know where you're at. So who do you like? You're in Florida. Do you like the Hurricanes or do you like Indiana?
It's the big question right now. I think Indiana is going to win the game. I do believe Miami has a legitimate shot if they play some bully ball and they play the perfect game, but more than likely it's going to be Indiana.
You know what? There's a really good moral to the story on this one. Indiana doesn't have any of the blue chippers, the 5-star recruits. Yep. They don't have anything. What they do have is a bunch of people with a bunch of grit. And Scott, I kind of think when I'm talking to you, I think you got a lot of grit when it comes down to it. So you got to appreciate that. So Indiana?
Yep, I think Indiana's going to pull it out.
Dude, I love it. I love it, man. Keep doing what you're doing. And by the way, guys, I want you to understand this. Scott right now is doing 70 plus deals, and he does this on a monthly basis. And he does it through grit, determination, and bringing great products to great people. If you were to advance this to your business, you could do the same thing. All you have to do is talk with my friends over at Angel Oak. Scott, man, I totally appreciate this.
Appreciate you, Brian. Thank you.